What is going on today, YouTube? Hope you guys all had a great day. And today, I want to talk to you about Chegg. I went through the SEC filings. I want to tell you what I found out and what I'm thinking about this company. If you're new to my channel, I make daily stock market videos just teaching you guys stuff I wish I knew when I first started. So if you like this kind of content, subscribe to my channel, leave a like on the video, comment below if you got any questions, and share it to someone else that could use it. So to jump right into it, Chegg. I've been watching this stock since about March 2017. And if we look back to the year from last year, March 2017 is back in here. I mean, this stock was trading at like $8 a share. And it's the whole way up to about 24. So it's about tripled its value since I started watching it. And I mean, it's had good earnings and everything. Well, I mean, for a started out company. If you don't know what Chegg is, Chegg's a online book rental help service for kids in high school, college. I used Chegg when I was in school, and that's just one reason I know about it. But yeah, I've been watching. I've been surprised by how much it's going up. So I wanted to actually look into its filings lately and see what's going on. And so, anyways, digged into the filings. This is a little different from the normal ones I look at because normally I look at penny stocks and I look at their SEC filings. But so I looked into their risk factors and I wrote them down so I don't have to browse through them while I'm going over this video. So I'm just gonna let you know what I found. Chegg is in a highly competitive market, and they say that in there. They say they're highly competitive with like textbooks, just regular textbook companies like Barnes and Noble. Amazon sells a lot of textbooks. Just colleges in general sell a lot of textbooks, and high schools in general. They have different ties to different companies out there, so it can be very hard to get a new textbook company caught on. I do like Chegg. I used Chegg. I thought it was a very helpful tool, and since I knew about it, and this company, I mean, it was founded back in 2005, so it's a little over 10 years old. I mean, it's going on 13 years. They've made some major adjustments. If you go through the filings, you can read and find out. But they do a lot of online services. They do a lot of online tutors. They're trying to keep up with the technology and trying to make their product superior to everything else out there. And they say they're in a highly competitive market because there's a lot of other companies out there doing the same things. One of their most notable things lately was a partnership with Kaplan, and that's just a big testing company. They do a lot of tests for like high school kids and stuff like that. And they just got that in August 2017. So that was back in here. You can see that news didn't really drive anything, but they partnered with them and they started making like study programs for their tests. So they have access to their tests and they can come out with material that'll help like high school kids for their tests. So that was some big news and expansion. And look further. I mean, the biggest thing right now, this is still a very risky company to invest in if you're looking for like a long-term investment. One being the fact they're in a highly competitive market. Two, they are actually still in major debt. They're in about $391 million worth of debt. Yeah, cumulative deficit of $391.6 million as of December 31, 2017. But they're coming out with a whole bunch of new services. They're coming out with things like Chegg Study, Chegg Writing, Chegg Tutors, brand partnership, test prep, and internships. That's the thing with Kaplan. Chegg Study Services combine textbook solutions and expert answers, which they're always updating and making new textbooks and everything. So they are trying to adapt and stick up with their competition, even though it's in a highly competitive market. And that's one bad thing. Another bad thing, they have high turnover rate because they need to get people in high school and college. And you figure everyone's only in high school or college for so long. So every time someone graduates, they're done with, say they quit after high school or they quit after college, they're done. They're not going to use Chegg again. I mean, they could recommend it to someone else in college, but they need to get that new subscriber. So a subscriber at the most is probably only good for like 10 years. So this makes them have to constantly advertise, spend money on advertisements, spend money on like SEO, search engine optimization to get themselves ranking on pages for their advertisements, and always keeping up with advertisement techniques. They have to like do studies to make sure they're actually popping up where they want to. That costs a lot of money. Their price, it can be drastically influenced by their competition. If a bookstore on campus makes their textbooks a lot cheaper, it's going to be hard to keep up with them. They're not going to be able to keep on dropping their prices and keep on making their profit. Like a college bookstore, they can keep on profiting on other stuff. Chegg, they're solely relying on textbook like answers, textbook study guides, stuff like that. They said they're relying on one shipping provider. So if their shipping providers, they fail to keep a good connection with them, they have to find a new one. He relies on UPS, so if something would happen to UPS, it's going to be very hard to get a new shipping provider. They said in here too, if they tend to experience a lot of traffic to their website when college gets in. And they said this is a big reason why their website could crash. Their website can't handle that much traffic. So that's another big key right there. If you're getting on Chegg for the first time, you want to order your textbooks and you need them right now. You get on, the website crashes, that's probably going to deter you away from it, and you're going to find your textbook somewhere else. And to get that all straightened up, they have to pay more money for that. So they're always in a constant battle with this kind of stuff. They're also surviving on investors right now. They said they're not getting enough profit from their products themselves, and they're relying on their investors and their company to keep on giving them money. And if they, for some reason, can't lock in those investors, they're going to start to lose money and they might go out of business. So that's another big key point. Now I'm going to go over stuff I do like about this company. One thing I do like about this company, their revenue. That's their cost of their sales. It is steadily increasing from 2015 to 2017. It has been going up from 133 to 182 to 255. And the revenue, that's just what they get from their sales or services. So revenue going up is always a good sign. Their profit has been increasing because they've been getting more people to use their services. So that's another good sign. And one reason why they don't have a rental service in here, sales service, said they partner with a company called Ingram. And this Ingram, they get a commission from Ingram for their rental and sale of print of textbooks, as well as revenues from e-textbooks. So it looks like they're trying to completely get out like their warehouses and not have the textbooks. They'll have their textbooks all stored through Ingram, and they will just get a commission off of their sales off of this. So they almost seems like Chegg is completely trying to go to an online tutor program rather than just making a profit through selling textbooks. And their tutoring, like their profit from this has been going up. And they can lower their cost this way because they don't need to keep on buying the textbooks. Rather, they give it to this other company, sub it out to Ingram. So these outside sources like Ingram take care of that, and they're solely focused on tutoring right now. But they still get a commission from these textbooks and referring these people to Ingram. A lot of their investments have been going and buying, you can see their acquisitions. They bought a company that can help them in their math technology. So that's going to help them out with their tutoring program. That was in 2017. 2016, they acquired a Easy Solutions LLC. It's a learning company based in New York of online writing tools. That's going to help their Chegg writing. So they are doing good things to help out their company in the long run. It's just hard to invest in a company right now. I mean, they are going up. They're consistently going up. But they have such a high amount of debt right now. So I still see this as a risky investment. But if you go in now and they keep on improving their products and like they are, this could be a good long-term investment. It's more risky right now because they are relying on a lot of stuff and they have a lot of competition. They don't pay dividends. They said they don't because they're using all the money they get to reinvest in their company, which is a good thing. It's never a bad thing. If they're actually using the money to invest in their company, which they are, because you can see they're acquiring new companies, they're doing research and marketing, trying to get their word out there. So it's never a bad thing if a company doesn't pay dividends if they're actually using this money for a good thing. It's different if they're just using the money and they're putting more money in their pocket rather than investing in the company. Then the last thing I want to go over in Chegg, I looked, and here's just, you can find in the SEC filings, but I find it easier to go to Yahoo Finance sometimes and just look at this. It's the same numbers. If you look in the consolidated balance sheets, or you can go in the SEC filings, see it's the same thing. Net loss 2283, 42 245, 59 210. So just to look at it quick in here, you can see their earnings. They're still losing money, but it's going up. Their revenue staying about the same because their sales staying about the same, but they're finding better ways to cut their expenses. So their earnings are going up. They're still negative, but they're going up. So if you guys like this video and it helped you guys go through SEC filings at all, or helped you in evaluating companies, leave a like on the video. Comment below if you have any questions and share it to someone else that could use it. And if you like this kind of stuff, subscribe to my channel. I make daily stock market videos. Just trying to teach you guys stuff. How to find your information, how to evaluate a company, anything. And I will see you guys tomorrow.